Welcome to Lesson 02, Market Participants. In Lesson 01, we studied how capital flows through the financial system. Today, we move from the flow to the players. Financial markets are not just charts, prices, and interest rates. They are built by institutions and people who borrow, lend, invest, insure, regulate, and manage risk. In this lesson, do not only memorize names. Train yourself to ask 3 questions: who provides capital, who uses capital, and who manages the risk between them. When you read a financial headline, always ask one question first: who is acting? A market participant may be a bank, a pension fund, an insurer, a regulator, a company, or an individual investor. Once you identify the actor, the news becomes much easier to understand. This is why market participants matter in real business conversations. If you can identify the player, you can understand the incentive behind the market action. Financial institutions exist because clients have financial needs. Retail clients need deposits, mortgages, credit cards, insurance, and investment products. Corporate clients need loans, cash management, foreign exchange, and capital market services. Institutional clients manage large pools of capital and need investment execution, custody, research, and risk management. Retail investors often react to news headlines, interest rates, and personal expectations. Their behavior can create momentum, but it can also create volatility. To understand financial institutions, do not only ask what they do. Ask how they make money. Commercial banks earn net interest income by lending at a higher rate than they pay on deposits. They also earn fees from payments, cards, wealth management, and corporate services. Investment banks earn advisory and underwriting fees. Insurers collect premiums and invest reserves. Institutional investors are different because they manage other people's money under rules, mandates, and performance targets. Their decisions often move markets at scale. In Taiwan, financial holding companies are a central part of the financial map. A financial holding company can own a commercial bank, a securities firm, an insurance company, and an asset management business under one group. This allows the group to serve customers across banking, investment, insurance, and wealth management needs. Commercial banks are especially important in Taiwan because many businesses still rely heavily on bank lending rather than raising money directly from capital markets. Commercial banks are the credit engine of the economy. They take deposits and provide loans to households, small businesses, and corporations. Their core job is to transform savings into credit. In Taiwan, commercial banks and financial holding companies play a major role in funding small and medium-sized enterprises. Investment banks operate closer to transactions. They help companies issue securities, advise on mergers, and connect corporate strategy with investors. Investment banks are capital market specialists. They help companies raise money by issuing shares or bonds. They advise on mergers and acquisitions, structure deals, and underwrite securities. A useful phrase is this: investment banks connect companies with capital markets. Asset managers translate client goals into portfolios. In English, you can say they allocate capital across asset classes, regions, sectors, and risk levels. Asset managers invest money on behalf of clients. Their job is to build portfolios across asset classes such as stocks, bonds, cash, real estate, and alternatives. In financial English, you will often hear the phrase asset allocation. It means deciding how much money goes into each type of asset. Insurers collect premiums and invest reserves. That makes them not only protection providers, but also long-term institutional investors in bond and equity markets. Insurance companies are both risk managers and major investors. They collect premiums from policyholders and pay claims when insured events happen. Because they hold large reserves, insurers also invest heavily in bonds and other long-term assets. This makes them important participants in capital markets. Regulators do not exist to stop markets. Their role is to protect confidence, reduce abuse, and make sure market participants follow transparent rules. Regulators create and enforce the rules of the financial system. They supervise banks, securities firms, insurers, and exchanges. Their goal is not to stop markets from moving. Their goal is to keep markets fair, transparent, and stable. Without regulation, trust in the financial system becomes fragile. Central banks are different from commercial banks. They influence the price and supply of money through interest rates, liquidity tools, and communication. Cross-selling means offering related financial products to the same client. For example, a bank customer may also need insurance, investment funds, or foreign exchange services. Cross-selling can make the relationship deeper and more profitable, but it must be suitable. A professional does not sell a product simply because the group wants more revenue. Financial holding companies are common in Taiwan. They combine banking, insurance, securities, and asset management under one group structure. Financial holding companies are especially important in Taiwan. A financial holding company owns several financial businesses under one group. For example, it may own a bank, a securities firm, an insurance company, and an asset management business. This structure allows the group to serve customers across many financial needs. Cross-selling can create convenience for customers, but it can also create conflicts of interest if products are pushed because of sales targets. A conflict of interest happens when incentives do not fully align. A financial group may earn higher fees from one product, while the client may need a safer or cheaper product. This is why disclosure, suitability checks, compliance rules, and professional ethics matter. Trust is an asset in finance. A professional explanation should connect function and revenue. For example, banks earn interest income, asset managers earn management fees, and insurers earn premiums. Let us practice the 3-sentence patterns from this lesson. First, X acts as. Commercial banks act as financial intermediaries. Second, X specializes in. Investment banks specialize in underwriting securities and advising on deals. Third, X generates revenue from. Insurers generate revenue from premiums and investment income. These patterns help you explain institutions professionally. When you describe institutions, use precise verbs: provide, arrange, underwrite, manage, insure, regulate, allocate, and supervise. Imagine a company needs funding. A commercial bank may offer a loan. An investment bank may arrange a bond issue. An asset manager may buy the bond for a client portfolio. A regulator supervises the process to protect market integrity. One funding need can involve several market participants. Your output task should sound like a short market briefing. Start with one institution, explain its function, then describe how it earns revenue. Today, we learned the main market participants: retail investors, institutional investors, banks, investment banks, asset managers, insurers, regulators, central banks, and financial holding companies all play different roles. Once you know the players, you can read financial news with much more confidence. I will see you in Lesson 03. By the end, you should be able to map a financial news story by asking which institution is acting, what is its incentive, and what risk is being managed.